And
Thank you.
Invite Feng Deng. Thank you, Feng Deng. So Feng Deng is an entrepreneur, very experienced, and had a lot of success. I forgot the name of the company, I'm sorry. Including many entrepreneurship awards that he's received. And now he's on the board of the Xin project, and hopefully can help us find this golden path between academia and industry.
It's okay. You don't know the name of my company because somebody says Netscape, which is wrong. It's
No, I
Netscape.
studied it, but I just had blackouts.
That's okay. Yeah. Well, there's one difference between me and Professor Lu is actually, he said, treat the project like a pig, right? How we talk to our entrepreneurs as an investor, we tell them, grow the company like your children, like your child, right? Sell the company like it's your pig. So that's the difference. Yeah. Well, so I'm going to talk about the startup environment in China and the U.S. on a comparative basis. So why not China and Israel? Because I pretty much know absolutely nothing. I don't think I'm qualified. Why I'm qualified to talk about U.S. and China? I used to be the entrepreneur in both China and in the States, in Silicon Valley to be specific. Also, I have been doing investment in China and in U.S. By now, in the last 9 years as a venture capitalist, I have invested like 90 companies. Most of them are early stage technology companies. I'd say that 80% are in China, 20% has some U.S. ties. Most, out of those 20%, maybe half of it is based in Silicon Valley, has R&D center in China or has market in China. So from that angle, I think I am qualified to talk a bit about this, and it does have some relevancy with China and Israel, how we're going to work together, technology and market, how we can compile, basically do that. Well, seems like this is, we'll talk about a little bit about the VC's investment in China. VC is actually good. Startups, innovations always go together with venture capital investment, right? Somebody says if there's no VC, there's no Silicon Valley, and vice versa. If there's no Silicon Valley, there's no VC industry. So from VC's perspective, you can actually understand the entrepreneurs and how to grow a company easier. So I think that's important. Opportunities in China from the VC's perspective. Where are the areas that people innovate? Where are the areas that can really create great companies in China and in the world? And also some comparisons between the two specific areas, Silicon Valley and Zhongguancun. A lot of times we try to, or Chinese would like Zhongguancun to be Silicon Valley or to beat Silicon Valley. Actually, VC started in China pretty long ago. In the early 1990s, the first VC firm is called IDG, started in 1993. But it actually grew pretty slowly. During the end of last century, there was a sort of a burst of the VC investment, but because of the dot-com, boom and burst, actually it went away. Up until 2004, when a group of U.S. VCs from Silicon Valley visited China, that actually triggered the resurge of the VC investment in China. So starting from 2004, 2005, a lot of the U.S. VCs actually went to China. Some of them set up their own team in China locally. Some of them actually, we call it fly-in VC. They just make several trips to China every year. And those VCs are pretty much gone by now. It's all the VCs. VC, at the end of the day, is a local business. You have to have your team make the local decisions there. So there's actually, and that was the VC investment by the US dollar. We call it, actually sometimes we call it like, you have two ends on outside, meaning that the money raised is not from China. This is US dollar. You got the money from the professional institutional investors in the States and in Europe, other side of the world, like endowment fund, foundations, fund of funds, those typical Euro suspect of LPs. And also the exit is pretty much overseas. You got listed in, New York Stock Exchange, NASDAQ, Singapore, Hong Kong, those kind of stock exchanges. But the investment, the company you invested in China, this has actually happened for pretty much like 90% of the investment in China by VC investment till 2009, when the China's domestic stock exchange called Chinext actually opened up. That actually opened up the gate for the RMB fund. These are the pure RMB investment. The money comes from the rich individuals, mostly the Chinese entrepreneurs who have already made their fortune in China. Maybe a lot of them are not in the IT industry. They are real estate developers, or they have some of their own business very successful in the traditional industries. So once the floodgate is open, there are a lot of the RMB fund formed in the first couple of years. 2011 actually was a peak year for the Chinese VC. There are so many new funds formed, so much money raised. Actually, you look at the number from 2001 to 2011, the amount of money raised actually is from less than $1 billion in a year to over $28 billion in a year. However, after that, there's a roller coaster ride. Basically, the next year, total money raised is just about 1/3 of 2011. And 2013 is even worse. It's actually another 30% worse than 2012. This year is getting basically a bottom, and it's actually started to getting up now. So we expect this year both the RMB fund and the US dollar fund will have a pretty good year. One of the direct reasons why they had such a roller coaster ride is because of the exit market. Last year, and actually the later 2012, the China Stock Exchange was shut down by the CSRC, China's SEC. So because of that shutdown, there's a lot of companies waiting in the queue, couldn't just get listed. And also the U.S. market, for a while, they treat Chinese company they have the so-called China premium. And later on, they have a China discount. There are some issues, scandals, and also some kind of regulative issues. We call it VIE. This is a technical term. But because of those issues, the Chinese company, harder to get listed in overseas stock exchange as well. Up until this year, again, China's stock market reopened, and you see a queue, basically pipelines of Chinese company going public in overseas stock exchange. The biggest one will be the Alibaba, which will be listed second half of this year. Probably going to be the largest IPO in history in the world. It's actually, people look at it pretty much. Right now, the valuation range is from $160 billion to $200 billion.
I didn't know it's Chinese.
Yep. Yep. Well, so actually, because it's different currency, U.S. dollar and RMB, the where you can list a company is different. But it actually gives the advantage to the Chinese entrepreneurs. They can choose which money they want. And at the very beginning they get the investment. And also, there are reasons why you go listed in China Stock Exchange or NASDAQ. Because of the, different stock market treats different companies have different criteria. And sometimes this kind of companies like internet company can get better, valuation in NASDAQ, while the manufacturing companies can get better valuations in China Stock Exchange. So it gives more choices to Chinese entrepreneurs. You have Chinext, you have Mainboard, you have NASDAQ, you have Hong Kong Stock Exchange. It's actually, in a way, it's actually provide a lot of the exit options to the entrepreneurs here. By now, Chinese market become the second largest market for the VCs all over the world, just next to the U.S. By far, it's larger than India, it's larger than Europe, and also larger than the Israel market. The Chinese VCs also evolved quite quickly. Like in the early 90s or even 10 years ago, Chinese VCs, they invest everywhere. A lot of the people came from the iBankings, so they just try to get the low-hanging fruit and try to invest in, maybe agriculture, education, internet, and solar everywhere, and they basically pick up the later stage companies. But now the competitive environment is so fierce, they force them to go from the later stage to the earlier stage, and force them to become more focused on certain sectors and to build the domain expertise in those sectors. And actually, this is a good thing for the Chinese VCs. So the whole VC industry is becoming more and more similar to how the US VC behaves. So the US VC actually started in the late 60s. It's pretty much like that. They're more generalist, and now they're more specialist. You have to focus on certain sectors that you know and build your connection, build your deal flow. That's actually pretty similar. But for the Chinese VC, we just moved very fast. We started from there about 10 years ago, and now we're pretty much like, maybe the exact, may not be the exact same like US VC, but like 10 years ago, the US VC. Still move much faster. That's kind of the today's situation. Why there's so much money? Because definitely I'm pretty optimistic about the investment opportunities in China today and also the next, I would say, at least next 10 years or so. You know, before we talk about specific sectors of interest, actually there's higher level driving forces for the whole microeconomy and also for the VC opportunities, right? The continued urbanization will keep driving more people from the countryside to the cities, maybe second-tier city and third-tier cities more than the top-tier, first-tier cities. There's estimated going to be another 300 million people moving from the countryside to the townships, to the different towns there. Of course, the rise of the middle class in China, if you look at the people's spending these days, and the growth of that is much higher than GDP growth. And the older generation are putting more attention to the quality of their life. The younger generation has a new lifestyle. So all these drive to the new consumerization, which is happening in China. As you can see that actually China has, it's the biggest luxury product market in the world. 40% of the luxury goods was sold in China last year, 40%, which is by far the largest. And there's also another driving force, basically the structural change in the industry. China's industry used to be like, you know, sort of a low-cost, labor-intensive, you know, those kind of a manufacturing industry. Now, because of the competition, actually, there's a government guidance, but also more importantly, there's a market force driving the whole industry uplift to another level. Technology, you know, or innovation-driven, differentiated strategy, all those things actually, they're giving more opportunities to the technology investment and innovation there. The next one is the whole, you know, the environmental issues and also the energy drives the low carbon policy, low carbon economy policy from the central government, right? So, and actually that will continue, even if sometimes you have a lot of resistance here and there, but we can see this is actually going to be a continued initiative for the next couple of decades at least. After we look at this level and then you look at the next level, what are the sectors that actually give us the return multiples for VC? Basically, VC invests in those high growth, low capital intensity, and you can use $1 to earn $10 back, give you that kind of a potential, even if the risk is higher, right? This is different than PE. PE or banks, they make money with money. So you put in $1 in, you get maybe $1.5 back, but risk is pretty much very, very low. So these are the areas that gave us the VC type of return. Of course, internet and mobile wireless internet, right? Smart devices. It's not initially. It's more of you know, sort of entertainment is the main sort of the main theme in China's internet industry. But now it's gone to the next level. It's actually basically disrupt a lot of the traditional industries. We talk about internet education, internet healthcare, medical services, and also like internet financing. You can see from retail, start from retail, that's what Alibaba is focusing on. Now getting into each of different sectors, completely change the business model, especially for China, because China's the traditional industry has a lot of different problems that the development country may not have. For example, the inefficiency of the distribution channel. With the internet, you completely disrupt all of these distribution channel inefficiencies. That's why Taobao got such a success in China. This is actually happening or will happen in the next decade for a lot of different industries. Consumer services, right? We have, like I said, the consumerization actually drives all different type of consumer services. These are, whether it's internet format or it's different type of format, consumer services, actually, you see more and more these things happening in China. And clean tech, of course, medical device, biotech, healthcare related, these are all typical VC investment sectors. But even agriculture, normally in the States, you wouldn't see VCs are interested in investing in agriculture. But in China, things like consolidation of distribution channels, those kind of resource consolidation opportunity exists. And that actually opened up an investment for VCs. This is a type of opportunity that only exists, not existing in the States, but actually exists in China. We invested in a hotel chain called Hunting Hotel, which is a Business Express hotel. In U.S., you have this kind of maybe Best Western, those kind of hotel chains, and actually the investment opportunity has long gone. But in China, that opportunity still exists. This is one type of resource consolidation that you can see, or channel consolidation you see happening in China. One thing more important to the group of people here is not where to pick up the best opportunities, is the ecosystem for the innovation, right? What's the difference and how we'll see the Chinese innovation ecosystem, the startup environment, whether it's better or it's worse than other side of the world, whether they can, one fundamental question is when or whether they can actually get to the level of Silicon Valley or even beat Silicon Valley. Is that possible? So, with my experience, I try to compare point by point several factors of the ecosystem for the startup. In terms of the most important thing is actually people, is the entrepreneurs, right? And actually, China and U.S. share a lot of the things in common as far as the entrepreneurs are concerned, right? A lot of them are very, very young, right? Like 20 to 34 years old, or maybe I think most of the entrepreneurs in China are less than 40 years old, younger people. Very hungry, eager to success, or, eager to make the fortune. Very passionate about the ideas, hardworking, and another thing is really, really quick learner. All of the entrepreneurs I work with, actually, I feel them there, fast learner. You have to be fast learner to be successful in China. But in terms of the I'm going to talk about why you have to be a fast learner in China more so than in the States, right? In U.S., actually, you could be a specialist. Let's say if I'm a technologist, I used to be the engineer in Silicon Valley, right? So when I start up my company, I don't have to learn the sales and marketing. Of course, I need to have the business mindset, but I don't have to learn it. I can recruit, or my VC can help recruit a CEO or VP of sales, right? But in China, it's impossible. There's some reasons. First of all, you don't see these layers of seasoned management people there. There's no that kind of a people. So the technologist, if he wants to start a company, he has to be his own CEO. It's very hard to find a CEO that shares the same vision with, right? And not only that, you have to learn the financial skills, because sometimes you're afraid of whether other people can not be so honest with you if in control of the, in charge of the financial department. Other things so he has to learn how to deal with government. In U.S., we don't have to learn how to deal with local government. Well, in China, because of the government involvement, sometimes you have to really, really deal with the government. So these are the things. So my feeling is, in U.S., you're a specialist. So you can be a champion of 100 meter, right? But you can be a champion of long jump. But here in China, you have to be champion of decathlon, which is very, very different. That any people, if you start with something special, then you have to learn the other things. So this is quite different in China. Actually, few more minutes. Okay. culture differentiation, culture are very different. U.S. entrepreneurs focus on differentiation, right? In China, they focus on survive, and a lot of times they want to do what you have. Right? So start with that. Like, talk about 3,500 startup companies in Israel. We have 35 declared China's Groupon in China, more than 3,500 actually. You know that. It's just they have to pass through this battle, and then they may survive. But in the end, you don't know which way is better, because those companies who survived turn out to be stronger than the company may just start from a specialty there. Focus is that's the same thing, right? But the only difference is actually failure tolerance is very different. In Silicon Valley, the startups, the entrepreneurs have higher tolerance to failure. Well, in China, that's still not the case. It's getting better, but still not the case. That actually explains some reasons why. Because they're afraid of failure, they have to do something, just survive first. That is another thing. Capital source, lots of angel investment in China, pretty much the same. The only difference is actually, on VC side, I want to talk more about it. In China, it's very hard to get venture debt financing. Not like in Silicon Valley, you have Silicon Valley banks, you have other things. You can get debt financing if you're a startup. But in China, small SMEs, very, very hard to get debt financing, even the venture debt financing. Exit market is getting better these days. One thing I think particularly interesting is actually the university's role in this ecosystem. I want to just emphasize on that. People were saying, hey, Silicon Valley success is because of Stanford. One of the major factors is Stanford, because Stanford provided a lot of talents to the Silicon Valley. It is true, but it's not just that. People say Stanford did a very good job about technology commercialization, which is true. But again, it's not only just that. My experience is actually the interaction between the Stanford professors and the industry is just everywhere. We have Stanford professors teach and goes to industry, start up a company, right? John Hedison himself started up a company, very famous company. And some people, even if they don't start a company, they sitting on the board. I sit on the board with the provost of Berkeley for a number of years. So he knows what we think. He knows how the entrepreneurs think, even if he's a professor. And sometimes they just angel investors. How many Stanford professors are angel investors? So many, right? We know those famous names there. And not just one way, the other way, industry people, industry veterans go to Stanford, teach in Stanford. A lot of them are actually venture capitalists or entrepreneurs teaching Stanford. It's kind of a regular job. So through this kind of interaction, I think the Stanford professors live in the industry, so they know really what's going on. They also helped, their mind thinking is actually changed. So they know when they do the research, they know what's the problem. We talk about problem-driven. They know what is the real problem for the industry. So they know where to focus. I think this is very, very important. For us, for the Xin Center, my advice is that we have to look at from this problems angle more. Government role is actually, this is something that I think China actually is doing better than U.S. U.S., yes, government do not, intervene with innovation. In a way, it actually, you don't have to bother. But in China, government's, heavy involvement at this stage of I think the innovation cycle is quite important. There are overheads, but overall, they help create the environment. Some of the funding, some of the ecosystem is actually built faster than without government involvement there. So my feeling is actually longer time, we don't need government involvement for continuous things, right? But for the time being, it actually is something very, very good. People are concerned about other things like the IP protection. I have to say that, yes, it is an issue. It has been an issue. It is still an issue, but it's getting better, much better. Look at the video copyright. Is one example of why it's getting better. Look at how internet music companies are evolving in China. In the last year and this year, you will see what I'm talking about. It's actually, it has been an issue, but it's definitely not the biggest problem in China. It will be getting better and better. It's not going to be one of the major obstacles for foreign investors to come in. On the other side, corporate governance, the transparencies, all those things, actually it is a big issue in China now. So sometimes people may not pay enough attention to this one. If you're a foreign investor or if you're foreign partner to the Chinese company, you have to pay attention to this thing. The culture side, there's something that they may not be as transparent as the Westerners want. So this is something I feel like all the foreign investors need to pay attention to. That's pretty much it. In terms of the focus, it's, you can ask me offline. Thank you.
Thank you.